The inflation story is a very emotional story for investors. They're always very concerned, especially when you have this huge amount of policy coming in. But we don't see inflation being an enduring concern. This is a transitory impact, but the numbers are going to get quite difficult to swallow in the coming months, although there is an argument to say we've probably peaked some of the worst of the headline numbers coming through into the markets. But we don't think this is going to cause jitters throughout the Treasury market or the interest rate market.
Just looking at what you fancy at the moment against that backdrop, Bill, US stocks and UK small caps. UK small caps is interesting. Where in particular would you have us go?
So look, I mean, the bigger picture here is you've got two drivers of the next stage of the recovery. You've got the next sort of cyclical upswing, which isn't a classic homogeneous upswing cyclically because of the way in which the governments have sort of bifurcated the way in which the economies can open up. So you had the opening up trade initially, and now as the economies fully open up, you're going to have the second wave of the cyclical upswing, which is going to be all about transport, hospitality, and larger sort of discretionary spending. That is going to be quite regional in terms of how quickly local economies open up and allow that second swing of cyclical recovery to occur. And we think the UK is ahead of the curve, especially with regards to its European peers. So small caps in Europe, in the UK, are going to continue to benefit at this point over the next few months. The other side of that is the bigger growth story.
Bill, let me ask you then on the credit side of the ledger. We had a fascinating conversation in the last hour about whether the Fed is in charge of the yield curve at the moment and whether that means you're buying treasuries at the wrong price. Where would you go to get some kind of uplift in yields but without taking on too much risk?
So the Treasury debate in terms of the 10-year and the Fed is an interesting one. The Fed is in, and they are going to be talking a lot and managing expectations. We see the sort of longer term trend. It will increase, slowly over time. The sort of 10-year note, the pain trade is probably closer to sort of 2.25, 2.5 over time. But we do think that the markets are going to overprice this in the shorter run. So with regards to the rest of the fixed income market, look, credit is quite tight, but it is reflecting the longer term sort of growth story and the sort of lower default rates we're going to have across the credit structure.
Did you say lower default rates or zombies that we're going to be left with at the end of this, Bill?
Hey, Steve. No, look, it is I've heard you guys quoting this morning the Goldilocks scenario, but look, credit's all about the expected levels of default into the system. There's a huge amount of fiscal policy, there's huge amounts of support. We have got a very pro-growth, pro-inflation policies coming out of the Fed and, broadly speaking, the G20. This is going to be constructive for companies and it's going to be constructive for credit.